In 1969, a man named Warren Buffett bought a small furniture store in Nebraska. Nobody wrote articles about it, no headlines, no hype, just a family-run shop selling couches and mattresses in a city most Americans couldn't find on a map. Today, that furniture store still exists. It still sells couches, and it has quietly generated more consistent profit year after year than half the exciting companies that dominated financial news during the same 50 years. Here's what nobody tells you. The wealthiest people on the planet aren't chasing the next hot startup. They're buying laundromats, vending machine routes, plumbing companies, storage units, the kind of businesses that make your eyes glaze over the moment someone mentions them at a dinner party. And that reaction, that boredom, is exactly why the wealthy love them. Stick with me, because by the end of this video, you'll understand a strategy that's been quietly building fortunes for decades, and why almost nobody talks about it. Let's start with what boring actually means in the world of investing, because it doesn't mean what you think. Boring doesn't mean bad. Boring means predictable. It means nobody's fighting you for it. Think about the last time you saw a viral headline about a self-storage facility. You didn't, because nobody wants to post about renting out a metal box to strangers. But that same metal box gets rented out every single month. Rain or shine, recession or boom. People don't stop needing somewhere to put their extra furniture just because the stock market had a bad week. That lack of excitement does something powerful. It keeps competition low. When something is thrilling, everybody piles in. Money floods toward flashy tech startups, cryptocurrency, the next big trend. And when everybody piles in, prices get inflated and returns get diluted. But when something is unglamorous, most investors walk right past it. Less competition means better prices, better terms, and less noise driving irrational decisions. The businesses immune to hype are often immune to the crashes that hype eventually causes too. Here's the second piece. Boring businesses tend to serve needs that don't disappear. Plumbing breaks whether the economy is thriving or collapsing. Laundry needs washing whether inflation is at 2% or 9%. Vending machines sell snacks in office buildings whether the NASDAQ is up or down. This is what investors call inelastic demand. And it's a fancy way of saying people need this stuff regardless of how they feel about the future. That kind of demand creates something rare, predictable, boring cash flow. And predictable cash flow is the raw material that wealth is actually built from. Now let's look at the numbers, because this isn't theory. According to industry data compiled by IBISWorld, the U.S. laundromat industry has generated consistent annual profit margins between 20 and 35% for decades, largely untouched by broader economic downturns. Compare that to the average retail business, which typically operates on margins closer to 5 to 10% and gets hammered the moment consumer spending slows down. Self-storage tells a similar story. During the 2008 financial crisis, while the S&P 500 was losing 57% of its value, the self-storage industry, as tracked by the National Association of Real Estate Investment Trusts, posted positive returns nearly every single year of that downturn. People were downsizing homes, moving in with family, going through divorces and job losses, and every single one of those situations created demand for a storage unit. Even something as unremarkable as vending machines tells the same story. A well-placed vending route can generate returns north of 20% annually, according to multiple small business acquisition analysts, with minimal ongoing labor and almost zero exposure to stock market volatility. These aren't unicorn outcomes. They're the norm for an entire category of businesses that almost nobody watching this video has ever considered owning. So why does this actually work as a wealth-building mechanism beyond just the cash flow? The answer comes down to something most people never think about: debt. Banks love lending against boring businesses. Why? Because predictability is exactly what a lender wants to see. A laundromat that's made the same steady profit for 15 years looks a lot safer to a bank than a trendy startup that might be worth a fortune next year. or worth nothing. That means these businesses can often be purchased using what's called seller financing, or SBA loans, sometimes with as little as 10% down. You're not paying full price out of pocket. You're using the business's own predictable cash flow to pay off the loan you used to buy it. The business essentially buys itself over time, and you keep the equity. This is very different from buying stock in a flashy company, where you're paying full price up front and hoping the value goes up. With a boring, cash-flowing business, you're buying an income stream. And using leverage, most investors never think to use outside of real estate. And because these businesses are hard to disrupt, a laundromat isn't getting replaced by an app anytime soon. That income stream tends to stick around. No venture capitalist is racing to build the next unicorn vending machine startup. There's no billion-dollar exit for someone trying to disrupt septic tank cleaning. And that lack of glamorous competition means the profits stay boring, steady, and yours. This is also why family offices and private equity firms have quietly poured money into what's called the search fund model over the past 2 decades, buying up small, unsexy, profitable businesses one after another. Harvard Business School has tracked search fund returns since the 1980s, and their data shows an average internal rate of return north of 30%, outperforming most traditional stock market benchmarks by a wide margin. These aren't Silicon Valley outcomes with one winner and 100 failures. They're built on steady, repeatable, unglamorous success. So how does an everyday person actually access this? You don't need millions of dollars sitting around. Small business acquisition has become far more accessible than most people realize. Sites like BizBuySell list thousands of boring, profitable businesses for sale every single day. Laundromats, HVAC companies, landscaping routes, vending operations, often for a fraction of what people assume. SBA loans exist specifically to help everyday buyers acquire businesses like these with a small down payment. Franchise ownership is another route, taking an already proven boring business model, think basic home services, and simply running it well in your local area. The first step isn't complicated. It's identifying an unglamorous, needed service in your community, one that already has steady customers and doesn't depend on trends, and looking into what it would actually take to own it. So let's bring this back to that furniture store in Nebraska. It never had a flashy pitch. It never trended online. It just kept selling couches, quietly, reliably, decade after decade, while the rest of the world chased the next exciting thing. That's the whole secret hiding in plain sight. The wealthy aren't smarter than everyone else, and they're not luckier. They just learn to see opportunity in the things everyone else finds boring. While most people are chasing excitement, the truly wealthy are buying predictability. One laundromat, one storage unit, one plumbing van at a time. So here's a question worth sitting with. What's the most boring, overlooked business in your own town? The one you've driven past 1,000 times without a second thought, because somebody out there is quietly getting rich off it right now. If this changed how you think about building wealth, subscribe